Hello and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. After years of being an international outlier, New Zealand appears set to get an insurance scheme for bank depositors. The Deposit Takers Bill, which is expected to be introduced to Parliament in the third quarter of this year, will establish a depositor compensation scheme protecting up to $100,000 per depositor per deposit taker, such as a bank or building society. According to the Reserve Bank, a depositor compensation scheme is expected to be up and running sometime in early 2024. It will be funded through levies paid by deposit takers, such as banks, and have a Crown backstop or government guarantee. It's a big deal, especially given Reserve Bank figures show total gross deposits of $424.189 billion as of June, with household deposits comprising $222.389 billion of those. To discuss deposit insurance, I'm joined by Geof Mortlock. Geof is an international financial regulatory consultant who works with the International Monetary Fund and World Bank, and he specialises in financial system stability, resolution of bank failures, deposit insurance, and other related matters. Welcome, Geof, and thanks for joining us. To begin with, I thought it would be good if we start at the beginning, really. So can you just explain to us exactly what we mean by deposit insurance and what the objectives of it are?
Yeah, thanks, Gareth, and good to be with you. Well, deposit insurance is basically a system under which if a bank were to fail or any other deposit taker were to fail, and that is if it became insolvent or something of that nature, then the authorities would implement a resolution of that financial institution, and that could take any number of forms depending on how big it is and so forth. But deposit insurance provides protection to depositors up to a specified limit, such that they are given two levels of protection. The first is that they are immunised from any risk of loss of money, and the second is that they are given prompt access to their money. So that's the two benefits that it brings. And why do countries, so many of them around the world, have deposit insurance? It's because it helps to promote the stability of the financial system. It helps to reduce the risk of depositor runs and makes resolving a failing institution easier.
Yes, you mentioned that lots of other countries have it. So the interesting thing here is that New Zealand's just getting to it now. I looked up some figures from the International Association of Deposit Insurers, and they say about 145 jurisdictions have some form of explicit deposit insurance. So why has it taken New Zealand so long to get to this position where we have decided we will introduce a deposit insurance scheme when other countries have had it for so long?
I think part of the reason is because the Reserve Bank has for a long time, and we're talking probably 20 years at least, taken what one would call a light touch approach to the supervision of banks. And by that I mean that they have licensed banks, they have supervised them, but they have avoided the conventional international approach to bank supervision of having on-site examinations and the normal regulatory frameworks. Now that's changed in recent years. They've become more conventional. But the reason they took that approach was they wanted to have a big emphasis on market discipline. And by that I mean depositors and other creditors of banks having strong incentives to monitor the banks in which they have their funds. They didn't want to detract from those incentives. And the perception in the Reserve Bank, rightly or wrongly, was that deposit insurance would erode those incentives by immunising depositors from any risk of loss. Now, that view is not shared by all, and there are many who take the view that market disciplines can still be preserved perfectly well by having a limit on the amount of deposit insurance cover, and we can go into that later, and by the way the funding structure is managed. So, for example, ensuring that higher risk institutions pay a higher levy into the deposit insurance scheme.
Yeah, it's interesting. You talk about the RBNZ's background. I mean, they used to talk about deposit insurance as a moral hazard and blunting incentives for banks and depositors to manage risks properly. Was there a catalyst or a particular champion to introduce deposit insurance in New Zealand? I mean, this deposit takers bill we're talking about has come out of the review of the Reserve Bank of New Zealand Act, which obviously was started by Grant Robertson after the 2017 election. But I noted that prior to that, the International Monetary Fund did what's known as a Financial Sector Assessment Program report on New Zealand. And among other things, they thought that New Zealand should introduce deposit insurance. So was that the key catalyst?
I think it was probably the single biggest trigger, to be honest. New Zealand has gone through two IMF FSAP missions, and the FSAP, the Financial Sector Assessment Program, it's a program under which most countries that are members of the International Monetary Fund undergo a review every X number of years. If you're a large country, it's every 5 years. For a small one like ourselves, it's about every 10 or 12 years. And its purpose is to evaluate the stability of the financial system and to assess the adequacy of regulatory arrangements and bank resolution arrangements. Well, there was an FSAP done in 2017 or thereabouts, and one of the recommendations was that New Zealand has a vulnerability in that we have no deposit insurance scheme, and they argued, and I agree with them, that it made for a riskier financial system. It increased the risk of depositor runs in periods of financial system fragility, and it makes it more difficult to resolve a bank effectively. Arguably, the absence of deposit insurance increases the probability that government would be forced to do a complete bailout at greater taxpayer costs. So yes, I believe the FSAP was a key factor.
Now, that $100,000 per deposit taker limit, I'm curious to get your views on whether that feels about right to you, because previously the government had said it was going to be a $50,000 limit per individual per financial institution, and that this would fully protect about 90% of individual deposit accounts. They increased it or doubled it to $100,000, but it's still well short of some other countries, including Australia, which is at $250,000. So what is your take on whether that $100,000 limit is about right?
I think it is about right. It is relatively low by the standards of several countries, that's true. So, for example, if one compares it to the level in the United Kingdom, Australia, the United States, the European Union, it is lower than those countries have when you convert into a standard currency, or when you express the deposit insurance limit as a percentage of per capita gross domestic product. So it is at the conservative end, but according to the data that the Reserve Bank has released, and I have no reason to doubt it, that with a $100,000 limit, roughly 93% of depositors are fully protected for the funds that they have in a bank. And remember too that it's $100,000 per depositor per bank. So if one had, for example, $300,000 that one wanted to put into banks, you could have $100,000 in each of three banks, and you'd be fully protected up to that level.
Of course, it's going to cost something to establish this scheme. The plan is to build up a deposit insurance fund. Interested in your thoughts on how big the fund should be and how long it might take to build this fund up. And then I guess, how much is it going to cost to establish a deposit insurance scheme, and who will pay for it?
Yeah, look, there's an interesting policy debate about how big a deposit insurance fund should be. And I guess the answer really comes down to, among other things, how stable is the financial system? What is the probability of a bank failing or a non-bank deposit taker failing? The higher the probability of failure, the greater the loss upon failure, the higher the target fund in the deposit insurance scheme would need to be. Now, in a country with a history of quite a low rate of bank failures and with, I think, reasonably good quality regulation, some scope to improve it, and an economy that by and large has not shown extremes in its overall performance, then I think that the deposit insurance scheme, the fund in that scheme, probably can be at the lower end of the international spectrum, and that would be typically around 3 to 4% of insured deposits. So that the amount of money in the scheme would be around 3 to 4% of the total amount of insured deposits throughout the banking system. And they will need to assess, well, is that enough, based on assessing the probability of bank defaults. They'd use a stress testing framework to evaluate that. Once they've decided on what the target of the fund should be, then the next question is, well, how long do we allow to get there? And typically the recommendation of the IMF for this is, if you're starting from scratch, as we are, you would allow maybe 7 to 10 years to get to the target level of that fund. So that would imply then a levy rate that is calculated per dollar of deposit to reach that target fund level over a given period, say 7 to 10 years. And it'll be paid for by depositors ultimately, because the costs are borne by banks, and they will probably pass that cost on to depositors, among others.
That brings me to the next question I had, which is, how will the introduction of deposit insurance affect the interest rates that depositors are paid? If, as you say, banks do pass on at least some of the costs of the levies to their depositor customers?
Look, it's hard to know, because it depends whether they pass all of the cost on or just some, and whether it's passed on only to depositors or some of it is passed on to borrowers. So it really depends on that. And I think one would be talking only about maybe 5 to 10 basis points. So you're not talking a big figure. If the target size for the fund is spread over a lengthy period, so you take 7 to 10 years to get there, you're building up the fund gradually, then the levy rate on banks should not be particularly onerous.
And in terms of the banks and I guess the building societies and other financial institutions who will be part of a deposit insurance scheme, how do they view it? I mean, obviously the big four banks in New Zealand are subsidiaries of Australian banks. They have had deposit insurance there for some years now, so in that sense they're used to it. But are they welcoming this, in your view?
I think the larger banks probably see it as a bit of a burden, because they probably take the view that they are not the ones who are going to benefit from it the most. That they would probably see it as being of greatest benefit to the small banks and the non-bank deposit takers, so the credit unions and so forth. And in fairness, that is probably true. That is internationally how it tends to work, that deposit insurance schemes tend to bring greatest benefit to the smallest financial institutions, because they are the ones generally that have the higher probability of default, albeit still low, and deposit insurance schemes generally, when they pay out, are paying out in respect of small bank failures. But that said, I think they would probably take the view that, look, this is in the interest of us all. It'll help to promote stability in periods of financial system stress. It is internationally conventional. Australia has it. So I think the Australian banks operating here would take the view, well, it would be unusual for New Zealand to continue to be the sole outlier. So I think they'd take a pragmatic view of it, really.
Now, there's been a few consultation papers out on how they may design the scheme, etc. And one of the issues that I thought was quite interesting in there was which products will actually be insured or covered by the scheme and which won't. Now, obviously, the likes of term deposits will clearly be covered, and the suggestion is transactional accounts, on-call savings accounts, redeemable shares from the entities who have such things, and maybe wholesale depositors, etc. But obviously, there's talk that interbank deposits, foreign currency deposits, and some other things may be excluded. I suppose it's going to be very important that the public understands which products are in and which are out. Do you have any views on perhaps what should definitely be in and out?
Yeah, look, I think you're absolutely right that clarity of what is in and what is out is crucial. So there is going to need to be a program of making it clear to depositors, are they protected or are they not in respect of a particular financial instrument. I think the ones that you would expect to be covered would be transaction accounts, term deposit, savings accounts. So your vanilla bank deposit. That is pretty much par for the course globally. Foreign currency deposits in most countries are not covered. The exception would be where a country has a lot of foreign currency denominated deposits, so countries in Europe, for example. But we are not of that nature. The vast bulk of the deposits here are in NZ dollars. You would not expect interbank deposits to be protected. That's quite normal, because you come back to what are we trying to achieve, and we are trying to protect the ordinary household depositor and deposits held by small businesses, those who are least able to protect themselves because they either have limited understanding of bank risk, which is understandable, and limited access to information, and they don't have sufficient funds to be able to diversify their risk by spreading it across multiple banks.
There's another suggestion that potentially some sort of depositor preference could be introduced. So this, of course, refers to the rankings of creditors or unsecured creditors if a bank is to fail. And they are currently ranked alongside other unsecured creditors. There would need to be a change to the Companies Act if depositors were going to be, I guess, moved up the queue. Do you think this is something that is desirable?
Yeah, I do. And increasingly, many countries are moving to some form of depositor preference. Australia has had it for many decades. So too has the United States. And many of the European jurisdictions are in the process of either phasing it in or have already adopted it. And the reason for that is twofold. One is it reinforces the protection of depositors in a financial crisis. So it helps to reinforce the message that, look, you don't need to panic, that you are protected both by the scheme and by the preferential ranking of your money in a winding up or other form of resolution of that bank. And secondly, it helps to give protection to the deposit insurance scheme, because the deposit insurance scheme has a subrogated claim on the bank. In other words, it steps into the shoes of the depositor. And so if the depositor has a preference, then so too would the deposit insurance scheme in a winding up. So I think for both of those reasons, it's sensible.
So we haven't had depositor insurance in New Zealand before, although, of course, we did have the Crown Retail Deposit Guarantee Scheme between 2008 and 2011, I guess when the global financial crisis happened, and we had a lot of finance companies that collapsed during that period, obviously headlined by South Canterbury Finance. Just curious if we could, and we have had, going back further than that, we have had banks that have got into trouble, BNZ obviously in the early 1990s, late 1980s. Just wondering if you could just, I guess, discuss with us a little bit, how have we treated failing financial institutions in the past, and what's that meant for depositors?
Yeah, well, look, you're quite right that we have been, in a way, lucky and partly good management, that we've had very few bank failures in the last 100 years. BNZ effectively failed, but was bailed out by the government and by private sector shareholders. But in the absence of that, it would have failed. So in that case, the bailout meant that, of course, depositors were not at risk. DFC was supervised by the Reserve Bank and was not a registered bank, but was in substance a bank, and it failed in 1989. Now, what happened with that was that the retail depositors were fully bailed out. They were repaid by the government or by a prioritisation of their funds, in effect backed by the government, and other creditors took a haircut. So unsecured creditors of a wholesale nature took a haircut in the DFC failure. Now, had we had more bank failures, I think we would have faced a situation where, in the absence of deposit insurance, it would have been very difficult to manage those failures in a way that preserved confidence in the financial system. I suspect the government would have done a form of bailout, either simply recapitalising the failing bank or protecting retail depositors from loss. Either way, I'm sure there would have been some kind of bailout. Under a deposit insurance scheme, that is pre-funded to a large degree by bank levies, and it does enable government to take a different approach to bank failures in the future, such that it can adopt a bail-in model for larger creditors.
Yeah, are we going down the bail-in route in New Zealand? I mean, I know that's has been in use overseas in some places. Do you think we're heading in that direction too?
Well, in a way, the Reserve Bank was early on the block in terms of its approach to bail-in. Indeed, when I was at the Reserve Bank, we first contemplated bail-in in the case of DFC, where that option was put on the table. So that would have been a lot earlier than most jurisdictions. What we're missing, I think, though, is a structured approach to bail-in, unlike lots of other countries. And by that I mean that most of the OECD jurisdictions have either introduced or are in the process of introducing contractual bail-in debt, so that banks have to issue a tranche of debt capable of being bailed in. And by bail-in, I mean either being converted to equity or being written down. So in either case, it helps to recapitalise the bank. Now, at the moment, the RBNZ has not done that. They instead have a form of bail-in their haircut approach, but I'm not convinced that that would be systemically sustainable in the absence of a no creditor worse off framework. And my preference would be, if we're going to go down a bail-in route, let's do it through contractual bail-in debt first, and then a proper statutory bail-in framework supported by a no creditor worse off safeguard.
There's a range of scenarios that could happen if a bank or another financial institution was to get into trouble. And I suppose the maybe, just thinking off the top of my head, the least bad scenario is one of our smaller banks or building societies has some specific issue to it that causes it to require assistance, which in the context of the broader economy wouldn't amount to a huge sum. And then I guess the worst case scenario is some sort of sector-wide contagion that potentially comes through the Australian banks from overseas, which would be your Armageddon type scenario. Would deposit insurance work in the same way in both those extreme examples?
Well, I think, first of all, deposit insurance would work by reducing the incentives of depositors to run on the banking system. Because, one of the big risks in a systemic crisis, so where, for example, maybe Australia is in some difficulty and we are as well, and people are nervous about the state of the banking system. In the absence of deposit insurance, there is an incentive for people to run, to pull money from their bank, maybe to migrate to the largest banks away from the smallest banks on the presumption of too big to fail for the largest banks. So I think deposit insurance would help to reduce that risk of runs. But realistically, would it be used to facilitate a resolution for a very large bank? I don't think so, because it won't be of a big enough size to really make much of a difference to the resolution of the largest banks. That in the case of the largest banks, the resolution would probably take the form of some kind of recapitalization of a slimmed down version of that bank, or some kind of business transfer. And some of the funding would come from shareholders' funds being written down, maybe some from bail-in, depending on how that is structured. Maybe there might be a need for a contribution from the deposit insurance fund, but that would have to be capped at what would it have paid out under a least cost depositor payout. And I think realistically for a large bank, it would be quite constrained in what a deposit insurance scheme could really contribute. For a small bank failure, yes, I think the deposit insurance scheme would be able to be used in two ways. One would be to do a depositor payout. So in that scenario, the failing bank or non-bank deposit taker is closed. It's not systemically important, so it can be closed. You would pay out depositors up to the insurance cap, and then there would be a conventional liquidation. You would try to find the best value you could by selling off viable assets. And the second way deposit insurance can be used for small banks is by what's called a purchase and assumption transaction. And that's how, for example, the American deposit insurance scheme works mainly. So they don't do payouts. Instead, what they do is they use deposit insurance funds to finance the transfer of deposit accounts to a healthy bank. And that is generally less disruptive and less costly than doing a payout.
It's interesting what you said about if a larger bank was in strife. So you believe that the deposit insurance scheme might only be used to a small degree or a limited degree. So I guess, does that raise the possibility that if one or more, I guess, of our bigger banks were in strife, there would still be potentially some sort of government bailout separate to deposit insurance?
Look, I think it would depend on the extent of losses, really. If the large bank that is failing has got a pretty significant capital base, and if it does have a tranche of contractual bail-in debt, that might be sufficient. Depending on just how big the losses are, that might be sufficient to finance the resolution of it without the need for government funding. If the losses are very deep, and if the government did not want to go beyond any contractual bail-in debt, so it did not want, for example, to apply a haircut to wholesale funds through a statutory bail-in mechanism, then some form of government resolution funding might be needed. And if one looks at other jurisdictions, so say, for example, if you look at Britain or you look at Europe, they have a separate systemic resolution fund that the large banks pay into, designed to cover this kind of situation. Other jurisdictions, such as Australia, have an ex post systemic resolution funding mechanism. So there's no ex ante systemic resolution fund paid into by large banks in Australia, but the government has a pre-appropriation mechanism in law that enables funding to be used for potentially large bank failures. But the aim should always be to minimize the amount of taxpayer funding that is put in, to try to fund the resolution as much as one can through the balance sheet of the failed entity.
Can you give us maybe a couple of examples of where a deposit insurance has actually been required overseas? I mean, obviously there have been bank failures around the world in relatively recent times.
Yep. Look, if you go to America, you look at the data on bank failures, there are failures every year in the United States, which is not surprising. It's got around 8,000 licensed banks, the vast bulk of which are very, very small state banks, state-based banks. And even in a good year, I think the deposit insurance scheme either does a payout or a purchase and assumption transaction for around 50 to 100 small banks, and in some years it's much more than that. So that's a regular thing in the United States. In Britain, they had deposit insurance at the time that Northern Rock failed, and that was used then, but they changed the system from a a rather complicated one to a much simpler one, where there was no shared loss between depositors and the taxpayer, to one where it was a pure deposit insurance scheme. So it was used in the United Kingdom. It's been used in various jurisdictions across Europe and across Asia. So it is a commonly used part of a bank resolution framework. And if one looks at the international standard on bank resolution, that's the Financial Stability Board key attributes. That's what the IMF goes in and assesses countries against. Then deposit insurance is a core element of that for how you deal with a bank failure.
There's plans for a Crown deposit insurer to be established, I guess to oversee the deposit insurance scheme, to run it, and suggestions it would probably be located within the Reserve Bank rather than be a standalone entity. Do you think that is the right way to do it?
My starting point would be a standalone entity if it were a larger country. But we are not a large country, we're a small country. And for economies of scope and scale and keeping costs low, I think it's probably pragmatic to locate it in the Reserve Bank, provided that it is separately governed. So what I would want to ensure is that the board of directors of the deposit insurance scheme is a separate board from the board of the Reserve Bank, that the deposit insurance scheme has its own balance sheet, not commingled with the Reserve Bank's, that it has its own governance, its own accounting, financial requirements, that it is separately audited, and it is accountable to the finance minister and accountable to Parliament ultimately, on a standalone basis, separate from the Reserve Bank. But I have no problem with it being drawing on the administrative resources of the Reserve Bank, and therefore being within the overall rubric of the Reserve Bank.
Well, look, thanks a lot for that, Geof. I think it's an issue that's of a lot of interest to our audience, deposit insurance. Geof Mortlock is an international financial regulatory consultant who works with the International Monetary Fund and World Bank, specialising in financial system stability, resolution of bank failures, deposit insurance and other related matters. And I'm Gareth Vaughan of interest.co.nz with another episode of our Of Interest podcast.